Hopefully you can all hear me nice and clear. Any issues, please do comment in the chat box. As you can see, today's webinar is how to set up your own limited company. We won't just be talking about this, we'll be talking around several areas around limited companies in general. So today is going to be presented by myself. My name's Samantha Skyring, and with me I'm joined by my colleague Andy Gibbs. Quickly, little disclaimer, obviously we're going to be talking around the general principles and issues that surround sort of limited companies, are very much a sort of introduction to, but obviously because everyone's individual circumstances are very different, some of the things we're talking about will be relevant, some may not. It might not necessarily be the right thing for you. So this disclaimer is just to warn you, don't act on anything straight away. Please make sure you get specific advice before you act on anything. So what we're going to be talking about today is what is a limited company. Obviously, you know, what it is, what it represents. We will then get stuck into how to set up a limited company. We'll talk about directors' responsibilities as well, and we'll explain what a director is. Paying yourself from your company, because that can be very different via a limited company. What expenses you will be allowed at the end, and also some key dates and deadlines to be aware of. I will just say this webinar should last about sort of 30 minutes or so, maybe a little bit over, and hopefully we'll have time at the end for some questions. So please do put any questions in the chat box as we go, and we'll come to those at the end. So what is a limited company? So some of the key facts. A company is separate from its owners. Okay, so its owners are actually the shareholders. So what this means is if the business gets into trouble, the owners are only liable by their actual shareholding. Okay, so it's that extra layer of protection. Very different to a sole trader, or as we also call it, an unincorporated entity, because obviously if anything happens to their business, that falls on them personally. But with a limited company, you have that added layer of protection. So as we've just said there, the owners are the shareholders, but the people running the business, the day-to-day running of the business, are the directors, and directors are classed as employees. Okay. Now, shareholders and directors for most small limited companies are normally the same person. Okay, you have to have both within a business, but you know, I could set up a limited company today. I would be a shareholder, so I would be an owner, but I would also be the director of my company as well. So I'd be an employee of my company as well as an owner. So company will actually pay corporation tax. That's a specific tax for limited companies. That rate of corporation tax is currently 19%. You must file company accounts. Now, this is quite a big difference with limited companies compared to unincorporated entities, so sole traders, etc. Is that the accounts that you file, for one, you have to file them, but also they're on public record. So other businesses and individuals, you know, they can log on to Companies House and they could search for your limited company and they would see the accounts that you've filed. Okay, so just be aware of that. The company must complete a corporation tax return, as you may imagine. The government wants their tax, and they especially want their tax off limited companies. The company money belongs to the company. Okay, now this is quite a dangerous area, especially if you've been maybe a sole trader or a partnership, an unincorporated entity before, and you maybe have incorporated into a limited company. This can be normally the biggest change to get your head round, because, you know, as a sole trader, it's kind of your business, it's your money, it's a lot more sort of free moving. But when you set up a limited company, the money in the company belongs to the company. It's not just yours. My colleague Andy, when we get to it, will talk a bit more about that in detail later. As a director, the reward for employment comes mainly in the form of salary. So again, Andy will go through that later. And then shareholders in a company are entitled to reward via their investment by way of a dividend. Okay, so slightly different terminologies. And again, different tax treatments as well, but I'll let Andy discuss that later. A few other points to consider are that with limited companies, you're often seen as more credible. because you have that reporting functionality whereby your accounts are on public record, other businesses who may want to work with your business as a limited company may feel a little bit more comfortable. They may trust you a bit more. You've got that credibility because they have that more visibility and they know that you as a limited company have more responsibility. Okay, so that credibility does come into it. So with the compliance side of a limited company, there are certain things that you have to be careful of. There are certain rules that you have to abide by, such as how the accounts actually look, how they're laid out, the rules that help you build those sets of accounts have to be adhered to. But one of the key things is the responsibility of the director, okay, because they're an employee of the company. They're responsible for looking after that company, okay, but I'll talk about that in the next section. So everything must be in the company name. Again, it sounds silly, but again, if you have transitions maybe from an unincorporated entity to a limited company entity, it's something to be wary of. All those names will have to be moved into the limited company. Could make funding trickier. So again, if you think about funding naturally, if you're applying for credit, obviously lenders will go above, want to look at your credit history, your track record, and assess whether they actually want to give you that money, whether they trust you enough to lend you that money. And with a brand new limited company that hasn't got a track record, that could prove difficult. So you may have to explore options of being a guarantor or, you know, holding guarantee over certain properties maybe to secure funding. So it's just an area to be aware of when you're looking at this. Company name, so the limited company name that is registered at Companies House, and the company number that is assigned to all new companies set up. I'll explain a bit more about that later. They have to be shown on all paperwork. So invoices, anything you send out to customers, suppliers, anything like that, you have to make sure those key details are shown on there so that anyone could potentially look you up if they needed to. So I will just hand over to my colleague Andy now just to go through some of the pros and cons.
Thanks, Sam. Yeah, just to recap over those pros and cons that you just mentioned, the main one that isn't on there yet, which we'll come on to it later, is tax. Because one of the main reasons why people will come to look at a limited company in the life cycle of their business, or maybe at the beginning, is really to make tax savings. Those have been reduced recently over time, but still limited companies generally win out when it comes to tax advantages and also in controlling those tax liabilities as well. But we will come on to that in a second. So the main things, just to recap on, what are the advantages of a limited company? As Sam was talking about, limited liability. So your exposure is very much just limited to the share capital of the limited company, and in many cases that can be as little as £1 or not much more, just a small nominal value, and that's the limit to the shareholders' exposure. Sam will come on to talk about some of the responsibilities of directors where that liability, if certain things are done incorrectly, can be expanded, but generally the liability with a limited company is much more limited, so you're more protected with a limited company. Companies also offer legal continuity because the company exists as its own entity, separate from its owners, separate from its managers. So the company has continuity. It can be passed, as it were, down. Family members can take over, or it can be bought and sold. Transfer of ownership as well. That's quite an important one. It's sometimes easier to transfer the ownership of a limited company and maybe more messy than other legal entities, where you can find a market for the shares to purchase your business. Borrowing is a double-edged sword, because sometimes banks will want personal guarantees, but a lot of banks will approach limited companies on a much more credible basis, and with the accounts that can be prepared for a limited company, this can give banks much more assurance when it comes to granting borrowing facilities. We touched on it just now as well, credibility. Limited companies generally give much greater credibility to a business owner. Some other companies will only want to deal with limited companies, so you have credibility advantages. We'll come on to some tax advantages later, but one other advantage is pension schemes. Pension scheme options open to directors of limited companies can be more generous than what sole traders can obtain. And finally, staff incentives as well. Sometimes it can be easier in terms of succession to pass limited companies over, much more easy to incentivise staff than perhaps with a sole trader business. Thanks, Sam. So those were some of the benefits of running a limited company. We come on to now some of the disadvantages recap. Administration. As Sam was saying, limited companies have filing obligations. They have to file accounts with Companies House and they have to file tax returns with HMRC. So there's a greater level of admin burden that comes with a limited company. Also, there is a degree of privacy which is lost with a limited company because certain details have to be made available on Companies House. A kind of short version of the accounts have to be filed with Company House, as well as other credentials about the directors and also certain share owners. Where you reach certain critical levels, your details will be disclosed on Companies House. Companies also have some disadvantages in that the transactions with the business owner have to be much more carefully looked at because the company money, as Sam said, belongs to the company. If you take money out, it can cause issues down the line, which we'll come back to. And finally, the director's responsibilities as well. As we were saying, although you do have limited liability, there can be instances where what they call the veil of incorporation can be lifted and directors can be found personally responsible in certain instances. So there are some disadvantages as well.
Lovely, thanks Andy. So next we come on to how to actually set up a limited company. So I'll just pull up all these different steps. So make sure the limited company is right for you. I would say that is absolutely key. And I would suggest that if you are unsure and you've not really looked at this before, this is where an accountant can really help you. So please do, I'll put all the contact details up at the end, but please do get in touch with us or speak to your already existing accountants. But because whether or not you should be a limited company is very specific to you as an individual and you as a business. You have to find out what's right for you, what's going to be the best from a tax point of view, but what's also going to be the best from a personal and sort of general running of your business point of view. Okay, so that is absolutely key. So before you make any rash decisions, you should definitely sit down with someone and sort of look at all the different pros and cons, what your specific situation is to work out whether it's right for you or not. And you may well decide that it's maybe not right for you now, but actually in a couple of years' time, it may become right for you. So there's nothing to stop you setting up as a sole trader partnership and then potentially incorporating further down the line. Okay. The next one, quite important one, choose a name. So it sounds silly, but obviously this is going to be the company's legal name. Obviously the name has to end with limited or LTD for short. You can imagine there are some rules around what names you can pick. Obviously, you can't pick anything offensive, anything with expletives in. So be wary of that. But also, you have to be very careful that it cannot be too similar to another business's company name or another business's trademark, etc. Because you could get then in dangerous waters where potentially they could look to pursue legal action upon you to get you to change your name. So just be wary of that. Now, luckily, when it comes to choosing a name, on Companies House, there's lots of guidance and they'll sort of point you in the right direction of what's allowed, what's not allowed, etc. You must choose the directors and potentially a company secretary. So as we said earlier, the director is basically will run the business. They'll be responsible for the day-to-day running and hopefully success of the business. We've put on their company secretary. Now that is a little bit more old school. It used to be mandatory that you had to have a company secretary, but it's no longer required. So you may want to elect a company secretary, you may not. Again, something you may want to talk to your accountant about. You must choose shareholders. So again, they're the owners of the business. Who actually owns it? Okay, now, like we said, if it's you setting up this limited company for your own business, chances are you will be a shareholder. But you may want other family members, friends, or whatever, business partners to also be shareholders. It just depends on your structure. Number 5, identify people with significant control. Okay, so this is people that have voting rights. So again, this has come to the shareholders again, or people with more than 25% of the shares. They are considered people with significant control, because although the directors run the business, the shareholders are the one that actually own it. So therefore, they can obviously dictate certain things that happen within that business. Number 6, prepare legal documents explaining how you'll run and look after the company. So these are actually, they do have a formal legal name, and they're called the Articles of Association or the Memorandums of Association. Okay, they're legal documents doing what they say on the tin. They will set out the rules that you have to operate that limited company within, the do's and the don'ts, basically. It's your rule book that you have to adhere to. Okay. Number 7, check what records you need to keep. So like any business, this is no real different to a limited company than to other entities, but you have to keep business records. So for a limited company, you're going to have things like you should keep a copy of your incorporation certificate that states your limited company name, your limited company registration number. You should also keep your legal documents, so your articles of association, your memorandums. You should keep all those together. But obviously, as your business grows and develops, things like, you know, bank statements, suppliers, invoices, all that sort of paperwork. Now, don't get me wrong, in this day and age, we're trying to be less paper heavy and more digital. It's all fine as long as it's in a digital format as well, but all those important documents will need to be kept as well. And again, depending on the type of document, will dictate how long you should keep it for as well. And then lastly, register your company. So this is formally done through sort of Companies House. You have to register with them as a new limited company. You have to provide an address that again is going to be on public record, so hopefully it's a trading address, but also you'll want to register with, say, HMRC as well, because obviously at some point down the line when the company makes profits, it's going to be taxable on those profits and it will pay corporation tax. So HMRC need to be aware of that, so they know to expect those corporation tax returns in at a later date. So next we come on to directors' responsibilities. So as I said earlier, this section here is, there are a few things to bear in mind when running a business as a director and being responsible. And as Andy rightly said, sometimes, depending on the situation, that veil of incorporation could be lifted and potentially they can come after you directly. So you want to make sure you know the rules in which you should operate. Now, hopefully, the rules that we'll go through now seem hopefully a little bit common sense, because obviously at the end of the day, the government just wants you to act in a way that is going to promote the business, you're going to look after the business, you're going to try your best to ensure that you're doing everything right for the business. So firstly, we have the company's constitution. So you must follow the company's constitutions and its articles of association. So follow the rules within those legal documents. You must promote the success of the company. It sounds a bit silly because if it's your company, you know, you're the shareholder and the director, chances are absolutely that will be top of your list. You want the company to succeed. So you must act in the company's best interest and promote its success at all times. You must show independent judgment. So you must not allow other people to control your powers as director. You know, you can accept advice from other people, but ultimately the responsibility lies with you. So you have to make sure you've done everything within your power to understand the situation, you've taken relevant advice, and you're happy with your understanding of the situation to then provide a final judgment on any particular business event. Exercise reasonable care, skill and diligence. So you must perform to the best of your ability. The more qualified or experienced you are, then the greater the standard expected of you, as you can imagine. So you always just have to try and do everything to the best of your ability. Avoid conflicts of interest. So situations that, you know, may back you into a bit of a corner, that you may feel, oh dear, I'm being put under pressure here to make a certain decision. You want to try and get out of those, and you want to be as transparent as possible with anyone that may be involved, you know. So, you know, consider positions and interests of your family, try and avoid any conflicts, and always make sure that you're upfront and open with other fellow directors within that company and also fellow shareholders, so that potentially, if need be, you can remove yourself from that particular you know, judgment that you may have to make. Third party benefits. You must not accept benefits from third parties that are offered to you because you're a director. So, you know, it can seem very straightforward and you know, not very obvious, quite menial in the grand scheme of things, but just be very careful, because obviously this is starting to step into the realms of potential bribery. So we don't want to go down those routes. So just be very wary of things like that. And then certain interest in transactions. So again, if there's a possible conflict there, you must tell the other people involved in the company, the directors, the shareholders, just to make sure that they're aware, especially if it's a small company, just so that, again, you're using that word transparency, you're being open and honest with everyone else involved. So there can't be any sort of things appearing out of the woodwork at a later date. Okay. And then next, I will hand over to Andy, who will talk about paying yourself from your company.
Thanks, Sam. At Tax Assist Accountants, we really enjoy working with business owners on their tax affairs, because it's probably one of the most important aspects for most of our clients to understand what taxes they have to owe and when. It is pretty critical for any business. And limited companies have a really important place there, because for many of our clients, it's going to be the way that they wish to run their business. So it's important to understand exactly what tax consequences they're going to have. As we said before, the company is actually separate from its owners and also from its managers. So its managers are the directors and its owners are the shareholders, and it sits as a separate entity to that. So the company will actually pay tax in its own right. As a director and as a shareholder, rather than being taxed on what's actually profit is in the company, you're really taxed on what you take out of the limited company. So as a director, you're technically an officer of the company, but for tax purposes, you're an employee. So as an employee, you can be paid a salary and you can even take benefits from the company. There are other ways that you can extract money, and we'd love to discuss with you where perhaps other extraction methods can come in, if maybe you can charge interest, or maybe if you're using property in your own limited company and you want to charge rent. So there's other ways to extract, but the main way that you will remunerate yourself as a director is through your salary. Shareholders, they're entitled to the rewards from their investment, and they can be entitled to dividends, money taken out from the company's profits. And in most cases, it's appropriate for a director owner, one who's both the shareholder and the manager of the company, to take a mix of these two ways of extracting to get the best possible tax mix that they possibly can. In terms of the salary has the advantage that it's allowable for corporation tax purposes, so it can be a deduction in the company, but it will be taxable on the director as personal employment income and put through the pay-as-you-earn salary system. You can earn up to, in 21-22, you can earn up to £12,570 as salary before you start to pay income tax in your own hands. After that rate, you pay tax at your marginal rate, depending on how much more you extract, at the rates on the screen, 20, 40 or 45%. As well as income tax being due on the salary, there's also national insurance charges to consider. If you take benefits from the company, you also have to consider these, because these will also count for tax, and it's where sometimes directors can get into a bit of trouble unless they take advice. So benefits could be things like if the company provides you with a car or a mobile phone, pension contributions. Some of those will be taxable and others won't. So we've put on there an example of a good tax efficient benefit to extract is a mobile phone. So where a company has a contract for a mobile phone and provides it to one of their employees, as long as they only provide one mobile phone to that employee, it isn't a taxable benefit on the employee. So it's a good, efficient way to provide mobile phones. Obviously in COVID situations, much more important for us to be mobile, much more important for us to have that flexibility. So that's a good thing to think about, providing employees with mobile phones, because it's very tax efficient. Dividends. So salary and benefits we've covered. Dividends are the profits that can be taken out of the company, and they're taxed at slightly different rates. So the first £2,000 of dividends, if you've already used up your exemption to tax for your salary, the first £2,000 are taxed at zero, and then after that, then again taxed at marginal rates, which we've got up on the screen. It will normally be appropriate to take a mix of those though. There also is what we've put up there, what is known as the director's loan account, because obviously officially we take out money either as salary or dividends, but where directors take out or put more money in to their limited company, then they establish what we call a director's loan account. Getting to understand that is very important, because you need to be quite careful about what you take out and when, because it can have unintended tax consequences. So for an example, if you don't declare dividends and if you don't take a salary, but you do take money out of the company, so money is coming out of the bank account, that's when it will cause a director's loan to arise. And if that becomes overdrawn, there are a couple of things to watch. If at the end of the year, the company's year, the director does owe the company money, then if it isn't paid within 9 months, then there will be a tax charge on that overdrawn loan account, which is called a Section 455 charge at 32.5%. And also, if the loan account is overdrawn by more than £10,000 at any point, then the director will be charged a benefit in kind on that overdrawn loan account. So making sure you discuss with your accountant early on how you're going to extract profits and your remuneration is really critical to make sure you don't get drawn into either of those situations. So, question we often get asked, what should you do? We'd be happy to discuss the optimum benefit and salary package. It will differ from person to person. There's no exact fit, although we've got a pretty good idea that the most tax beneficial route in many cases will be to maintain a low salary, which gives you the most advantage from a personal tax point of view and from a corporate tax point of view, and then top the rest up with dividends. So that's one thing that's really important to discuss with your accountant, just to make sure that you've got that correct mix in place so that you pay the lowest possible tax that you can, and also that you are fully aware of when the liabilities will come up, because that's obviously key as a business owner to make sure you know what's needed to be paid and when.
Lovely, thanks Andy. So what expenses are actually allowed? So again, these rules are a little bit different to if you have previously maybe been an unincorporated business. There are a few slight different quirks, but generally on the whole not too dissimilar. So generally the company can claim for expenses that are considered wholly and exclusively for business purposes. If there is a dual aspect that may have a slight sort of personal benefit to it, then potentially there's going to be some further tax consequences on the individual as an employee or director by way of benefits. And also where possible, money coming out of the business paying for any type of expenses where possible should try and always come from a business bank account. Okay, just because with your bookkeeping and your records, with any business you run, it just enables you to streamline everything, make sure you don't lose anything, you can keep track of everything a bit better, and it just keeps everything a bit more organized. So we sort of encourage that. Some of the sort of examples of expenses, rents and rates of properties used within the business, insurances, various business insurances, whether it's professional indemnity or motor insurances, anything like that. Bank charges, obviously if you do have a bank account. Advertising and marketing costs, obviously promoting your business. Staff costs, so the salaries and tax costs associated with your staff members are allowable deductions. Phone costs, again, as Andy discussed about, you might be paying for mobile phones for yourself or staff members. Professional subscriptions. So again, this is more dependent on the type of industry you're in. Some professions require certain subscriptions, and obviously, some industries you want these subscriptions to help you keep on top of what's happening in the industry, what's changing, what's developing. Equipment expenses, so it could be things like vehicles, vans, it could be particular plant and machinery equipment, could be office equipment, computers, hardware, software, all these different types of things are allowable deductions for your company. Okay, there are certain sort of quirks, so travel costs, again, if you're traveling as part of your business, I'd like to say for the most part travel is sort of allowable, but there are very specific rules. with pretty much most things that happen in accountancy, there's what we call general rules, and then there's the specific rules. So for the most part, travel, depending on what you do, could be allowable, but there are certain instances that it may be not. So again, it's about understanding those rules. And the same thing for equipment expenses, depending on what it is, you might get relief, but rather than just getting relief as an expense, you might get relief by way of what we call a capital allowance. But again, slightly different rules. So areas like this that are a little bit sort of grey and require a little bit more knowledge, this is where you should be leaning on your accountant to help you decipher what you can claim. Because at the end of the day, us as accountants, we're here to help you. We want you to claim absolutely everything that you are entitled to claim, because by doing that, it's going to reduce down your taxable profits, and by reducing down your taxable profits, you're going to pay less tax. Okay, which is what we all want. Unfortunately, you know, we can't just automatically wipe it to zero. We've got rules that we have to adhere to. We want to protect you as a business as well. We want to take away the headache so we can help you work out what you're allowed to claim. And then next, we just have a few key deadlines that I'll pass over to Andy for.
Yeah, thanks, Sam. Those are just the deadlines that you just need to be aware of. As we said before, for a limited company, there are certain obligations. So we've just put up there, I won't go through them all, but some of the deadlines that you need to think about, critically making sure that your accounts are filed on time and your corporate tax return is also filed on time. There's various other company secretarial requirements, but we'd be happy to help with any of those requirements where they're needed.
Lovely, thank you, Andy. So that kind of comes to the end of our sort of main presentation. You can see on screen now, how can accountants help? So me and Andy have both sort of touched on this throughout the slides. And at the end of the day, there's lots of areas we can help you with, because, you know, we understand that your main job is to run a business. That's what you're good at. That's where, you know, your livelihood is. That's where your time is invested. That's where you're making your money. And you don't want to get bogged down in all this, you know, the accounting standards, the legal stuff you have to be aware of, the big rule book of the do's and the don'ts. What can you claim? What can't you claim? All the different things that are out there, and also all the different like tax opportunities that are out there. There are loads depending on individual circumstances, which is why we always say everyone's situation is different. You know, so we can help you decide whether a limited company structure entity is best for you. We can explain what your responsibilities are in hopefully a nice clear-cut way that will make sense, and you'll be able to think, yeah, great, I understand that, I'll make sure I do that. We'll help you plan your remuneration strategy. So again, based on what Andy was talking about, looking at what is the right mix, you know, can you take a salary? What's the best level to take the salary at? You know, what dividends should we take out? Can we take dividends out? What tax are we going to be paying on those dividends? Any benefits that you could require, that, you know, what's the best way to get those out of the business? Looking at use of potential directors' loan accounts, depending on your situation, that there might be a need. All those different things, again, coming back to expenditure, what's allowable, what's not. We'll make sure we explain that to you so you know the sort of rules within your working. But again, we'll take all the pressure off. We'll produce the limited company accounts for you. We'll ensure that they comply. We'll make sure they get filed on time. We'll produce your corporation tax returns. We'll compute your self-assessment tax returns based on the money you've taken out of the limited company. You know, we can advise you on the tax that you're going to have to pay, but also tell you when. Pre-warn you, let you know. We'll calculate your tax today, but we'll tell you that the deadline is in so many months, years, whatever time. So you've got time to plan, because like anything, we all know we have to pay tax, but you have to factor it in. You know, cash is king, as we say. So we want you to have enough time to factor that into your cash flow, and help you if you think that cash flow is an issue. You know, we can help with things like that too. So do get in touch with us and talk to us today. The contact information will be on the last slide that I'll bring up. So get in touch with us, get in touch with your local accountant if you've already got one, or come speak to us today. We will happily sit down with you and go through everything based on your personal situations. Oh, I've gone back one. Questions? Oh, no, I didn't. I missed one. Sorry. It's just to point out we are open for business. Obviously, during this pandemic, obviously, we're doing more sort of telephone or video consultations. Hopefully, things will be opening up very, very soon. So you'll be able to come into our local shops and meet us direct. And just key to point out that, You know, we do agree fixed fees. We don't want you to have unexpected costs down the line. So we always talk to you first. We always agree the fees to begin with. And initially, all we want is the chance to sit down with you, have a free initial consultation with us. We can explain how we can help you. And then it's your decision as to whether you want to join us as a client of Tax Assist. But there is more information on the website should you wish. And let's have a look if we've got any questions. So yes, I can see we've got a couple. So in relation to will the shareholders directors be the same? Not always, but in most small limited companies, you know, and I say small with a pinch of salt because, you know, your turnover could still be in the millions. But generally, structural wise, you might be small, and very much you know, you could have a single shareholder director. That's the only person working in that limited company. So not only are they the owner, the shareholder, you know, it's their business, but they're also the director as well, and as such an employee of the business. They can be one and the same. But as I said, as things, maybe the business grows and you look to change the structure of things, you can well have very different shareholders to directors. It doesn't really matter. It's completely up to how you want to do things. A question, will individuals see company returns on Companies House website? So tax return information, no. And that's for self-assessment, so personal tax, but also corporation tax. They do not appear on public record. It's only the accounts of the limited company that appear on Companies House. And it's also worth adding that when you produce limited company accounts, because there's this whole host of rules and regulations that you have to adhere to make sure they comply, there are certain formats you can use, and this is where your accountant can guide you and help you. And there are formats that are a bit more restricted, so maybe they don't give quite as much away as some of the other formats. So things like that can help you keep a little bit protected, but still declaring what you have to declare to obviously make sure you comply. And then how long do we have to keep records, and HMRC, how far back can they check? So there's kind of two different things there. So generally, as a rule of thumb, because certain things have slightly different time limits, 7 years, okay, for accounting, anything to do with accountancy sort of records or any records with the company, 7 years generally. I would also caveat that what I call important documents, so incorporation, certificates, memorandums, articles, they have to be kept forever. You know, things like deeds of properties, they have to be kept forever. You know, what I call big, substantial, important documents, they have to be kept forever. Things like, you know, if you've got documentation in relation to loans that the company may have, again, you'd want to keep them minimum for the time that you have the loan, but again, 7 years following that. That's the sort of default parameter. So I would always think anything important, just keep it forever. Things like accountancy records that sort of change year on year, generally the rule of thumb is 7 years. Now, in relation to HMRC and how far back they can go, I don't want to go into too much detail in this area because their powers can change. Now, for the most part, they can go back, I would argue sort of standard, sort of 4 years is quite sort of standard. But if HMRC find something that maybe implies that you've acted with what they call, you know, you've acted with no care, you've done something deliberately, there's potentially they think you've not done something quite right, you've hidden something, that whole sort of deliberate, potentially, you know, you're trying to disguise something, anything a bit dodgy, as I call it, it does give HMRC extra powers, and they could go back, I think scarily, up to 20 years. Okay, now I'm pleased to say that's, you know, that has to be quite severe, whatever they've found, to trigger them to do that. But it can happen. But again, this is why we want everyone to be speaking to an accountant, because we can guide you. And if for whatever reason you do have an investigation, because sometimes HMRC will just launch into an investigation because you've been randomly picked out of a pile of names. Okay, sometimes they find something, other times they're doing spot checks. Okay, and again, as accountants, we can help you deal with those investigations and help you deal with HMRC, and even deal with HMRC on your behalf, so you don't have to get too stressed and worried about it. But again, it's a bit of a varying answer there, but hopefully that gives you enough to point you in the right direction. But I think I can't seem to see any more questions coming in. So for those of you that have been watching, thank you very much for your time. Oh, sorry, I've gone too far. Appreciate the time and effort. Obviously, if you have questions following on from this webinar, please do get in touch with us. We'll be happy to answer any further questions if you didn't want to write them in live. But like I said, I encourage you that if you haven't already got an accountant, please use the information you see on screen. Get in touch with us. You can arrange a free initial consultation with us, and we can talk you through your specific situations and help you through any things that come, and hopefully help you build a nice, successful business. Not just help you with a compliance. We want to help you build and strive and have that successful business that you've always wanted. So thank you very much for listening.
Thank you.
Super. Bye.